also wanted to really welcome the people who've been courageous enough to come out in the morning on a Friday, at the end of the week. And really, this is going to be an excellent webinar and talk because we've got a really great panel that we've lined up. And what's going to be really good about it is we've got some views of people coming off who've been involved for a very long time in the climate market, the climate change, mitigation and or adaptation markets. But from the perspective of banks, from the perspectives of investors, from the perspective of how do we get these projects financed and going over time. And so, as you can see, this is a project that's put out by the USAID. I am the chief of party. My name is Marcia Trump, and I'm with a very long name, but it's a Climate Economic Analysis for Development, Investment, and Resilience project. Our focus as a project is basically helping to make the case, business and economic, for why climate change actions need to be undertaken and can be done financially as well as sustainably over time too. So it's looking at how do you transition to a low emissions, carbon resilient economy and development path over time. More of a dialogue. So those who are on the webinar, I think it's you're not going to have as many slides to go through, but the content's going to be really extremely interesting. And I know just from our preparation, as we always do, we always have sort of a vibrant dialogue about issues. It's a good way that people get to know each other. And we want the same type of thing with the audience, i.e. the people in the room, as well as the people on webinar. So send in your questions. We have polling questions for those of you who are online. We also are going to be talking about some generic questions that feel free over time to come back and make some comments. If you're from an organization that you maybe have a different view or have some other ideas about, we're really looking forward to having that type of a dialogue. As we all know, Paris set a different tone. We had people who are in the room right now who had attended Paris, in addition to most of the people here on the panel. And people came back with a feeling of vibrancy, but also a feeling of, okay, now what does this all mean for us? What does it mean for our prospective organizations and sort of the future in climate change too? So Eric will start off, and then we'll go on to Matt Arnold as well as Vikram Widge, both extremely, we're extremely pleased to have them and honored to have them as speakers. And then we usually put together when we're doing these slides, some idea that you know where we're going with the webinar. What are the takeaways from the webinar? So one of the first ideas is, what are the private sector perceptions of Paris? Is it something that came on their radar screen more than some other conference of party agreements? Is it something that they see now they really need to take a more active role? Because I think, and to be honest, the private sector has, although involved with a lot of these types of investments, has not been as visible at some of these conference of parties in the past. And I think this one was a bit of an exception. I don't know if you guys agree with that too, but I think there was certainly a momentum there. Then also just to understand the barriers and the ability to scale up for the private sector to continue participating in the climate change market. As the folks in the panel will say, they've been involved for quite some time, but the idea is how do we scale up to meet, as you'll see, a financing gap, which is what Eric will talk about too. And then also look at the current developments in climate finance from what they're doing, what their organizations are doing, which is the USAID, the World Bank, and JPMorgan Chase. And then also, what are the roles that the government can play in this? So I'm going to turn this over to Eric. Eric is from the Global Climate Change Office. He has worked in this area for many years. He's also working with the Green Climate Fund, too, for USAID, if I'm correct. And he's worked, as you would see from the slides, in different positions before. Okay.
Great, thank you very much. I'm joined today by two distinguished guests. Matt Arnold on my far left is Global Head of Sustainable Finance at JPMorgan Chase, Vikram Widge. Immediately to my left is the head of climate and carbon finance at the World Bank based at the IFC. Today, as Marcy mentioned, we're going to talk about a number of current issues that are related to climate finance. In particular, we'll be looking at what, if anything, the Paris Agreement means for climate finance from the perspectives of various institutions. And we'll be looking at different perspectives from different sectors and bringing resources to bear to address climate mitigation and adaptation, or low carbon, climate resilient development. I think we'll just go ahead and jump right in to the conversation. So Matt, let's start with you. You have a very interesting background. You're in the banking sector now at JPMorgan Chase. But before that, you were in the NGO world. You started your own organization, Sustainable Finance Limited. You were at the World Resources Institute as their chief operating officer, which is an interesting and big job. And earlier in your career, you worked at the U.S. Environmental Protection Agency, so you've seen the public sector side. Since 2011, you've been working at JPMorgan Chase. I believe it's the largest commercial bank in the United States.
By assets, it's the largest in the world.
And so it's certainly a very large institution. And that's an interesting place to sit. You're leading their environmental affairs department, as I understand, and sustainability work. So tell us a little bit about your role there and how does it relate to climate change?
So I'm called the head of sustainable finance, and we have, globally, there's about 20 of us. There's a risk function, because we're lending money into the heavy footprint industries all over the world. We're a big energy bank, oil, gas, power, infrastructure, mining, agriculture, et cetera. So we have a team of 8 that evaluates over 1,000 transactions a year, and then identifies best and worst, and then partners with best and coaches worst. We have almost a think tank. We do philanthropy. We're actually, JPMorgan Chase has $250 million a year in philanthropic funding. Not so much focused on this agenda, but we got a little window. So and we do thought leadership. We engage stakeholders daily, people who come in and want us to do various things, stop this, start that. And then we have a little banking team that interfaces with internally, because we think there's a huge business opportunity for us in this whole space, but it's not totally obvious. Most companies don't come to their bank for advice on this topic, and so it's a big educational process to convey to the marketplace, as it were, that actually we're players in the game too. And then we invest. We have a pool of capital that we've been investing more broadly than climate. We call it social finance, think impact investing, disadvantaged communities, sort of poverty alleviating kind of investments, frontier markets.
Great. What challenges do you see based on where you're sitting in encouraging more climate-friendly investment policies?
Climate-friendly investment policies. So the markets are agnostic. Financial markets, they don't have social intention. The social intent is liquidity. And they will flow, the capital flows to things that have a favorable balance of return with risk. And so challenge number one is climate friendliness has to have a favorable balance of return and risk. If it does, it will be, there's no limit on the capital that will flow into it. And it's that simple gap between the notion that we want this money to have a social purpose, which is climate mitigation, to the climate mitigating universe needs to convey itself as a creditworthy place where you can generate attractive returns. And it's a dialogue. We were remarking just in the preparation for this panel on the cultural gulf between the world that I inhabit in the private banking sector and the government. There are 42 acronyms that I didn't understand just in the prep call, and so there's that, and that's an important mix of and so the purpose of a group like mine, and by the way, every bank in the world practically has a group like this. The Chinese banks have them. Some are more robust than others. Some are more offensive. Some are more defensive. Some are more PR. but fundamentally the capability is there. And we try to inject the social intention. We're sort of like a direction finder, a weather vane for, we as individuals would like this bank to channel capital in these agendas. How do we get there? Well, we get there by getting the favorable balance of risk and return. And so we're sort of, in a way, the guides through the wilderness for this agenda.
That makes sense. And I want to come back later in this conversation to these different perspectives, because I think that's an important theme for this group and for this topic. On the other side of things, I mean, since you've been in so many different sectors, what do you see as the opportunities that you have in your current role that are the best things about that? What are the things you can do now that you couldn't do from other institutional perspectives?
Well, the scale is just breathtaking. Our balance sheet is $2.4 trillion. We have a $1.4 trillion asset management business. We have the world's largest investment bank. We have one of the largest consumer banks. So you go, wow, that if you could just nudge that a little, you could make a big difference in the world. And so I'm in the nudging business. And the opportunities here, the cool thing that I find culturally is, first of all, people don't connect the dots. They think they're bankers or whatever. They're investors. They don't go to this agenda. But when you connect them, people get really excited. So we have folks the woman who leads our green bonds business. She wasn't an environmentalist. She loves this. This is people get newfound meaning into their lives. And so as you connect more and more of that, the opportunity, and we'll get into the bond market and so on, but the opportunity to me is the notion that folks can bring this sense of purpose and doing the world a good deed into their day-to-day job. It's sort of a bit of, I realize that my response is a bit parochial, but that's how you unlock. That's how we unlock the 270,000 very talented, creative people that work at JPMorgan Chase and the $2.4 trillion is by conveying it. There's a real opportunities here. Our clients want this. The governments are working for this. The governments are out there to de-risk the project. There's a whole landscape out here.
That's exciting. We'll come back to some of those opportunities. I want to turn now to Vikram. Vikram, you're in another very large global institution, the World Bank. You're based at the IFC. You've been there 22 years. And you've been developing financial products to mobilize capital, and you're also managing the bank's carbon business. Tell us a little bit about what the bank is doing, the World Bank is doing to mobilize private capital.
Yeah, thanks for having me here as well. This is great. I don't know, big is relative, right, after Matt puts out those numbers. So just to put it in context, and I'll speak for IFC, 45 billion or so balance sheet, and about 8 billion under management under our subsidiary, which sort of not so creatively is called the asset management company. So that just sort of puts it in contrast to the 2.4 trillion. So that's how we go from billions to trillions. That's the answer, and we are done, right? So I think I will tell you what we are doing today, but after today, the goal is going to become helping him unlock that money. Look, I mean, having put that in context, I think the only way I can spin this is that we are punching above our weight, so to speak, because we've invested as IFC probably about $13 billion in the last 10 years in climate-related, what we call climate-smart sort of investments, right? And that's primarily mitigation. In the recent past, we've done some adaptation. We can talk about that. But so I think it's the multiplier effect. The MDBs, the multilateral development banks. That acronym you knew, right? That was not one of the 42.
You're our client.
Okay, so I'm gonna try and use less acronyms. This is DC after all, right? So the multilateral development banks say, and just to put this in sort of just to give some numbers, put about $28 billion into the same business last year. But so if you look at the multiplier effect, on average, IFC is maybe a little higher because it's private sector, but on average, that's a multiplier of between 2 and 5 times. So you're looking at effectively mobilizing perhaps somewhere between 50 and whatever, 100 billion, 120 billion dollars a year. That's good, but that's clearly not going to be enough, right? I mean, so the theme of the World Bank, some of you have heard this before, even for IFC, I guess from a private sector perspective, the vision is world sort of free of extreme poverty and shared prosperity. And the only reason, I mean, it's not a mantra we sort of tell our private sector clients on a day-to-day basis, but at the same time, I think the theme that runs across the institution on the public and private side is that climate change is going to completely upset that cart. It's going to turn back. If we don't address it, then it's going to reverse the gains that we've had in terms of the development and addressing poverty and all the other issues that the two institutions, the broader World Bank group, is committed to. So from that context, I think the focus, and especially after building on the momentum of Paris, and we can talk a little bit more about that, is in fact on how do you actually, from a climate change perspective, what should our focus be? And that's sort of pretty much focused on eliminating, I guess, extreme vulnerability, because you cannot eliminate vulnerability totally, and to help decarbonize development. Where we sit, and not at IFC, but at the bank. Bank has a privileged association with developing countries. I mean, those are the World Bank's clients. So in terms of these so-called intended nationally determined contributions, how are we going to help these countries actually implement these, right? How are we going to get them to put in place the policies, whether it's carbon pricing, whether it is other sort of economic and fiscal policy that's going to help them redirect flows to low carbon sort of investment, right?
Let me ask you about that. Carbon pricing is a topic that's gotten a lot of ink over the last decade or more. You're in a good vantage. You have a good vantage point on that from where you sit in the World Bank. What do you see as the opportunities for carbon pricing? The bank's been talking a lot about carbon pricing. Do you think there are real opportunities there that could be put in place going forward?
So I think the opportunity is building on the momentum that we have seen. It started with the climate summit that the UN Secretary General called in September 2014, when carbon pricing was a bit of a pariah. People were like, what are you talking about? But with kudos to the team, and I'm sort of peripherally involved, but they have completely transformed. And the coalition that's been built around that for government, for subnationals, national governments, private sector, sort of is huge. It culminated in 6 heads of state on stage in Paris, sort of effectively saying this is it, this is the way to go. And along with sort of the World Bank group and the IMF's president behind it. Now, there are different ways of doing it, right? I mean, there is a push for taxes, and there are proponents of markets. Well, I guess you're going to have a mix. Markets, which is sort of, I guess I'm on the market side of the business, but markets are not going to be a panacea for anything anyway. They are a smart way of getting so-called carbon pricing disseminated into the certain sectors of the economy where it's amenable, but you're going to need taxes, you're going to need regulation, you're going to need performance standards. So the key is we might have 1,000 businesses signed up behind carbon pricing, and this so-called CDP now sort of documents hundreds of companies that are using internal carbon pricing, but those are hedges. That really doesn't translate into redirecting flows unless governments actually start to enact policy. And the examples which many people have heard already, British Columbia has successfully implemented a tax. They have demonstrated investment flows being redirected, and they've created a neutrality by sending money back to the taxpayers based around that. I mean, that's just one example. We at the bank have something called the Partnership for Market Readiness that's working with 18 different countries to help them see what is it that they want to do from preferably market-based approaches, right? Every country is going to do what is best for them. And that's, I think, while difficult, probably the most outstanding feature of what came out of Paris. Everybody's committed. There's no top-down approach. Everybody is going to do what is best for them, even from a carbon pricing perspective. Of course, that's going to mean huge challenges, and those of us who think that there will be carbon markets 2.0, that means there's a huge bridge ahead that we need to build, because this approach means there's going to be fragmentation of approaches. You're going to have different type of so-called asset classes even within the carbon market, and there is going to be a huge push to look at policy-based interventions, whether economic, fiscal policy, because those can make a huge difference. But they do have, benefits for mitigation. So how do you bring those kind of things in a very MRVable, I will use that, monitoring and verifiable in a very, which you can monitor and verifiable way to, and for those on the webinar, I'm looking at Matt at this point so that he doesn't get lost on the acronym. I'm kidding. So there are challenges ahead, but it's also very promising in terms of where I think the momentum is taking us. The challenge, I think, is going to be the hundreds of billions, and I'm sure we'll talk about that. How are we going to ultimately facilitate that? You talked about what is the bank group or IFC doing to mobilize capital, and I think we should get a little bit deeper into that, but there's a lot of stuff we're looking at in clean energy, in sustainable cities, in transport, in smart agriculture, in all the sort of industrial efficiency, and those are sort of the places that we are focused on going, and we are committed now to upping the game to, well, the stated target is 28% of all our commitments need to be climate smart by 2020. For the IFC itself, that will mean, because of the baseline growing, nearly doubling where we were. We were at 2.5 billion last year. We're going to have to go to 4 to 5 billion a year. Nothing compared to Matt's numbers, but at the same time, I think the story is going to be not what we do in terms of putting our money out, but what do we do to help others, bring others along, because the multiplier has got to go up hugely, I think.
Can I just jump in on this relative numbers thing? Because all of that money is thoughtful money. All of it has a social purpose. That's the purpose of the World Bank. People can disagree on outcomes, but so they are the beacon. They are the vanguard. They're the ones who created the green bond market, which we're now followers in. When I got to JPMorgan, the very first client meeting that I was able to arrange was with, guess who? The World Bank. They're a very important client of ours. And so the bankers inside us that cover the multilateral development banks, they're the first ones who said, hey, this is a really interesting opportunity. If we try to understand what our client, the World Bank's mission is, we'll be better bankers. So the leadership role that the leadership role that you play is absolutely vital. So the relative numbers, and these 2 points, if we can get close to 28%, right? I mean, think about that.
Yeah.
So, if we can get 5%, it'd be a huge win. So
it's a partnership, not a competition.
And I think that's
that's what I'm trying to say.
That I think
we follow them. Literally, they have hundreds of domain experts that we learn from. There's 15 or 20 of us. There's hundreds, thousands of them.
So I was just teasing Matt, for the record. I think this is a great
We didn't meet today, you may have noticed.
It has to be a partnership between because the development banks can only do so much, right? The unlocking the private capital. Take the example of green bonds. I mean, I'm sorry if this sort of throws your agenda off, but it was the bank and then the IFC who sort of issued the first green bonds. We went to benchmark, but that's okay. I mean, between banks issued about $8-9 billion to date. IFC is at about $5 billion. What is the total market is 80 trillion for bonds or so, but the green bond market is at 50 billion. But that's huge already, but that's because the likes of JPMorgan and their peers said, okay, this is a product I can do something with and take it mainstream. So my job is now to stop worrying about what the green bond market as AAA issuers are going to do. That's his to take to 500 billion. I am going to worry about how do we take green bonds to the next stage? What are we going to do with green bonds? How are we going to push the market into project bonds, asset-backed bonds, local currency bonds?
Let me turn that around. Let's talk about green bonds, and I think that's good that you brought that up.
We've got to talk about your slide.
It's a very hot topic.
Yeah, we got to
right
talk
now.
about it.
So we have. I put up a slide for those of you who have your backs to the screen, which is I think 3 of us. We have.
Can this be seen on the web?
Yes, it can.
Okay.
Yes. So this is just a slide that illustrates, it came from actually from the World Bank Group, and it illustrates the rapid pace at which the green bond market has taken off. $37 billion in 2014, $42 billion in 2015 in issuances. You know, what should we make of this? Is this what's the opportunity here, and what can we do to make it bigger if it's a good opportunity?
Okay, so if you had 2015 on there, it wouldn't be anywhere near so breathtaking because it flattened out dramatically. So this is both a hugely exciting and hopeful thing, and also a deeply cautionary one, as are most things. That pop essentially is the super sovereigns, the multilateral development banks, essentially branding capital that was already deployed to those objectives. And there was a lot of cynicism inside some of these groups. So wait a minute, you're going to call that a green bond now? I mean, there's no additionality in that. And there is no standard for additionality in this market. So essentially, this isn't really new capital going to green projects. But for the first time ever, you have a significant, I mean, 40 billion is a significant market that's branded in a way, and there are standards around it. Under the IFC's leadership, 4 banks and now many banks are adherents to something called the Green Bond Principle. So there's standards privately set, but there are standards around what it is to be a green bond. The concern, so why don't you do more? This is called debt capital markets on Wall Street. This is debt capital markets. So our DCM desks are all fully briefed. We have a green bond expert who has a team, and we market this to all of our clients. The corporate market, and so the expectation was that having led the way, that corporates would pick up the pace. That has not happened. And the reason it has not happened is because there's the return risk ratio isn't favorable. And in this case, it's a reputation risk. 2 companies that issued were criticized for the use of proceeds. Greenwash. So there's a significant downside to doing this. And there's almost no upside at this point. The sort of pioneer glow is over. So you don't get the first anymore.
So what do we do about that?
The market itself is trying to correct that. If there is a pricing benefit to it. So initially it was a PR market. Hey, we issued the first green bond into this sector, and on this continent, in this currency, whatever it was. There was a first thing. Now there's got to be a commercial benefit to it. Either the debt's a little cheaper to the issuer, or there's a premium to the investor. So there's this tension between the investor and the issuer. The investor wants a premium, the issuer wants a discount, right? So it's a tension there. We're seeing a little bit, very little bit, minor, teeny pricing differentials. If that were to lock in, we measure these things in basis points. It's 1/100ths of a percentage point. So 5 basis points would be 5 1/100ths of a percentage point. Differential would open this up dramatically. So that's where the market's got to head, is that the greenness is reflected in risk. So the argument here is that these projects are less risky because they're not subject to greenhouse gas intensity policy changes or whatever. So this is a climate resilient investment, and so therefore it's less risky, and so therefore the issuer is getting a slight discount. If that happens, we win.
Vikram, what do you think?
I couldn't agree with Matt more than I do, because I think that's where we need to go, because the glow will diminish because the market, and we can debate that, but the investors and the market is asking for a lot more impact reporting from those who are issuing green bonds. What are you using my money for? I want to know. That question doesn't seem to be asked of the rest of the debt capital markets. They're asking that question of 50 billion, not the other 80 trillion, on an extreme way, right? And I want you to bring up the issue of disclosure with Matt and how that's going to affect all this, since he's on the committee. But the issue there is that has a price. And I think unless we see some price benefit, this glow could diminish. And this is on public record, so I'm going to get beaten up by my treasuries. But the point is, I think while having led the way, we need to sort of also try and do newer and different things. As a AAA issuer, we get the money, we deploy it in climate projects, but how are we going to actually use this instrument to mobilize more capital? And that's what I was referring to earlier in terms of the different kinds of bonds that we're doing. But the other, so, the project bonds, asset-backed bonds will come. There are some examples, even locally, from a company called Hannon Armstrong, based out of Annapolis, who's issued asset-backed securities for solar sort of installations. But how can we translate that into for us, the developing country, the emerging markets? Countries where there is already an issue with the bond market. Okay, green bonds come later. First, you have to actually have the capital markets performing and operating more efficiently. So there's a lot of focus using the green sort of approach on how do we enable financial markets, how do we get the framework of capital markets so that corporate bonds and bond issuances can happen, how we're working with 18 different banking regulators who are part of a sustainable banking network. How are we going to address that? How are we going to address the insurance sector and domestic market for resilience? What about sort of the pension funds? Because the domestic markets are going to be huge, and the commercial banks there. One example is a bond that we recently sort of helped issue was a bank called Yes Bank in India, and where IFC helped them put together the bond. They issued a green bond, and then IFC bought part of that green bond as sort of an anchor investor, if you will. And those are the kind of things we want to be doing in order to help promote that market. We've also issued sort of bonds in Peruvian soles so that insurance companies in Peru who wanted diversification of their asset base could buy these bonds. So if you look at, and you probably will put up a slide on what the landscape looks like, the issue is that if you look at the numbers, nearly 400 billion last year, 60% or two-thirds that was private sector, and 3/4 of that was in-country. So the in-country capital markets and the in-country financial flows are key. So we want to be sort of focusing that and helping build those markets so they can then twin up, hopefully, with the whole green bond phenomena at one time. Because a long time ago I said something which I was teased about, but I think maybe I'll say it again. When asked what it wanted to be when it grew up, climate finance said it wanted to be a bond. And I think that's where we need to go.
Let's come back to the Paris Agreement as we advertised from the beginning. Bill McKibben said recently that the Paris Agreement won't save the planet, but it may have saved the chance to save the planet. What's the Paris? Do you agree? What's the Paris Agreement mean for Matt? Why don't we start with you? What's it mean for your organization? And if you were in Paris, tell us if there was anything you saw there that was interesting or surprising to you.
So I was in Paris. I was not in the official venue. Actually, what happened was a lot of business organizations organized their annual meeting in Paris those 2 weeks, and so there were a lot of business people there to create. My sense is to create the optic of participation, support, and so on. So I could have been in Paris in October or March, but I happened to be there in December. The thing I noticed most was the security. I mean, it was just incredible. You got searched every time you went to your own hotel. When we came back, I asked my team to put together a kind of summary memo to be sent out throughout JPMorgan Chase, and it was fascinating, the debate that occurred about how to cast it. Was this a spectacular dud, or was this really a great, promising hope? And I think you could credibly argue both sides of that. I think where we've gotten now is kind of what McKibben said. We've got, for the first time ever, 187 countries or whatever said, we got to solve this problem. So that really helped, I hope, U.S. politics on the issue, because this is no longer some rogue operation, right? This is every country in the world said this. The INDCs were already, and by the way, who developed that acronym? But the INDCs were already, kind of set, so we didn't get any new commitments. But you got conviction out of Paris, and I think so. How does it help our institution? It creates. There's no direct connection, but it creates momentum for the issue, and the expectation, because what has to change is the economics of these investments have to change. It has to become that greenhouse gas intensive investments are more risky. And if that doesn't happen, if governments don't change the economics by internalizing the cost of carbon, whether through prices or some other way, regulations fine, technology standards fine, performance standards fine, prices fine. Prices is only one instrument. If those economics don't change, this market won't go anywhere.
Vikram, what about the bank? Is there anything that surprised the World Bank Group from what happened in Paris? Or does the world look different now than it did 2 months ago?
Well, I think the surprise from Paris was the Paris Agreement itself, right? I mean, I was not there towards the end for the euphoria, but I was there for the first week, 8 days at least, right? So
You were there for the numbing part.
so yeah, and I think it was interesting. But I think there was a first day of heads of state when the security was super crazy.
Yeah, I bet.
Sort of set the tone in many ways. And I guess in hindsight, you can say, okay, this is how it was going to come out, but it wasn't that clear then. What was very different for us this year, and I think we had seen the momentum build up, was so the governments were there, everybody was talking to each other, fine, great. But what was present, integrated into the whole theme, was what I would say the business, banks, and the bucks, the institutional investors, and the broader investor community, right? They were represented at very senior levels, a lot at CEO level, and consistently across in the private sector, in the finance panels, in the resilience panels. And that was a huge shift from a couple of years ago when they were out tucked off in some, not quite the suburb, but people in Warsaw were saying there's a bridge too far, private sector's outside the tent, and what's happening sort of inside the so-called COP tent. They were all there. They were in there, governments were talking to them. So the momentum is huge, there's no doubt about it. And what Paris brought home was a clear signal that what climate change, addressing climate change means it's economic transformation. This is not going to be business as usual anymore. So I think in that sense, McKibben is right that it is a chance, it saved the chance to save the planet. So fine, great. But for us, when we came back, we were in this sort of dichotomy. I think the clarity on the bank public side was much better. You have a mandate to engage the public sector clients. There are these NDCs, you tally them up. They themselves need over $13 trillion in financing. If they want to meet the 2-degree target, they need $16 trillion in financing. So, how are you going to help these countries through policy lending, through other investment in all the areas we talked about, that with the government do? On the private sector side, we had the same dilemma he did. We were writing this memo to our management saying, what does Paris mean for IFC, the private sector investment? And, it's not obvious that this is an investment opportunity next month. But what it is a huge signaling device, that it means that the world is going to change. It's not going to be a world where the economic development is going to rely on fossil fuels. It's not a world where we are not going to be able to sort of just continue doing what we are. And I mean, I don't want to monopolize this, but the examples coming out of some of our client countries, whether it is China, whether it is India, when you talked about green bonds earlier, China has completely issued guidelines on greening its financial sector. Over the last month, I think China has issued like $8 billion worth of green bonds. Chinese banks have at least. And China, of course, has dominated the clean energy scene, but India has declared huge sort of ambitious targets over the next 5-7 years.
Let's come back to this billions to trillions theme that you raised earlier, Vikram. There's been a lot of talk going into Paris on, and certainly as a donor government or a donor agency at USAID, we're very cognizant of the role that donors play. There was a lot of talk going into the agreement about how are the developed country governments doing against the $100 billion commitment they made in Copenhagen. And this slide shows the results of a report issued by OECD and the Climate Policy Initiative. The evidence is that we're doing well. There's $62 billion has been mobilized in public and private finance. But then the question is, and as your leadership has raised, Vikram, and Secretary General of the UN, Ban Ki-moon, has mentioned, we need to move from billions to trillions. And it's not a public sector. There's not enough public resources to do that. So it's really, as we've been discussing, how do we mobilize? How do we use those public resources to mobilize the private resources to free up the playing field to create opportunities? So that's something at USAID, we're very focused on that. Going into Paris, we helped 26 countries develop their nationally determined contributions, their INDCs, intended nationally determined contributions. We were very pleased to do that. But the question is, how do we go from billions to trillions? And this is just one estimate. We won't say it's necessarily our view, but it's a slide just to kind of to give some framing. There's a large need to implement the Sustainable Development Goals, including climate change, and how do we do that? So what do you see as what's the pathway, Matt?
So I want to just step back. I fully agree with your characterization of the vibrancy of the business participation in Paris, and in stark contrast to Copenhagen. Copenhagen, the expectations were sky high and they were completely trashed, and it was way too cold. In Paris, I think the expectations were appropriate and they were met. And that difference is,
and the food was
stupendous,
good.
and the food was unbelievable.
All about the food.
Oh my! Well, and you could, yeah. Food was good. All of our competitors were there. In a couple of cases at extremely senior levels. We had a couple of business CEOs there. So the breadth and effectively the seniority of the business participation was unprecedented. So I wanted to I agree with you there. I think before you get to trillions, you got to get to 100 billion. Markets, $1 trillion markets start with $1 million trades. And you need to get things worked out successfully. And I think we go back, just to use back to this green bond example, this market has to create some economics in it. And if it does, it'll grow. It'll grow to 100, to 200, to 500, and to $1 trillion. And so that I think, the way you get there is not gradually. Steeply is fine, but it's not tomorrow. It's 10 years from now, and you don't get there without a massive pipeline of investment-worthy projects and businesses that sort of fit in the bucket. And that's the entrepreneurial class's work to do. It's not yours. It's not ours. It's the business people and entrepreneurs all over the world who need to build those business plans and capital budgets and so on. And I think that's happening. And we'll get to what role the government can play, because I think there's an essential role.
Let's talk about that.
De-risking. So the numbers that you put up there, you had about 50 billion in government. What if that 50 billion were 100% dedicated to the 10% loss tranche in a capital stack? So if you track that, you roll up a 10% first loss piece, then some cheap equity for, let's say, another 30%, and then 60% some commercial term lending. So free money, patient money, and cheap money. You could probably lever that up by a factor of 10. So that 50 billion could become 500 billion. In a mathematical model, I realize that there's all kinds of problems with my math, but conceptually it starts to work, because we've done that. We built a vaccine commercialization fund with the Gates Foundation, and the Gates contributed a first loss tranche, and then we went out to corporates, institutionals, and high net worth investors and raised 5x, and that fund now operates and it exists. So this is a model that is proven. And there are all sorts of deep, I've said first loss. Vikram can give us a tutorial on all the instruments. There are dozens of different ways to do this. And so that's the role.
Vikram, what's your perspective?
So I think, Matt touched upon a few things that are going to be key to this whole issue. I think, but just stepping back, I think it's incumbent upon governments to effectively use this opportunity to translate their INDCs, which I'm told at least the I will drop as soon as the agreement gets ratified. So it no longer will be intended. They will become NDCs, but whatever they are, is to translate them into business plans for the money they need. And the public monies that they have now, the MDB flows are not going to become the first loss tranche, but I think the MDB flows can become even smarter in terms of what Matt was saying about helping de-risk. So I think we have to help countries build the deal flow, which comes from ensuring that the economic fiscal policies, the capital markets, all the regulatory frameworks are in place so that it attracts the private capital. It starts to de-risk at that level. You need to help countries build the deal flow for everything from large resilient infrastructure to city level to power to sector and everything else. So there's a huge public-private partnership that needs to sort of get into it, and countries need to be involved in it. The bank is looking at doing something called strategic investment funds that is going to help countries take pools of money, help develop robust, resilient infrastructure projects, and then stay invested in them so that at least it forms one tier of what Matt was talking about. Then you have to help aggregate both the deals and the finance in a way to scale. Because, as an extreme example, you take rooftop solar. If you're going to do rooftop solar, India itself has committed to 40 gigawatts of it by 2020 as part of their 100 gigawatt solar commitment. Now you talk to the developers, it's 5 megawatt at a time, 10 megawatt at a time. Those are impossible to finance at a scale that's actually going to be meaningful for the big bucks, the institutional investors, right? So you are going to have to find ways of aggregating, of creating standardized models, underwriting criteria that actually get finance flowing. You can pre-qualify developers, you can have underwriting criteria, you create warehousing type structures, these get financed, you de-risk them, you stack them, you de-risk them with credit enhancement, first loss, whatever, and then you issue bonds or you securitize them in some way so you can recycle money. But no institutional investor is going to talk to you unless you have at least 100 million, preferably a 500 million type deal, because they need a part of it. They're not going to take the whole thing. So I would say the country, from a public policy perspective, getting regulation, economic and fiscal policy right, and that includes carbon pricing, rolling back fossil fuel subsidies, and all the other good stuff. So sending those signals, helping create the deal flow, aggregating it, and then de-risking it, and then you start attracting the sort of larger finance. It's a simplistic formula, and there's a lot of work that needs to get done around it, but that's the way you're going to move to hundreds of billions. Okay. And then once we get to that, Matt will do the trillions.
Great. Let's switch gears just a little bit. Another sort of theme that one hears often is that there's trillions of dollars out there in institutional capital, pensions funds, and so forth. And a lot of the way that some of the, I guess you could call them advocates in this space, have been going at this, thinking about groups like Ceres or the CDP, Carbon Disclosure Project, Carbon Tracker Initiative. They've been sort of talking about how do you create more disclosure. Matt, you've been involved in this space. Could you talk a little bit about that?
So, yeah, there are a huge number of disclosure initiatives, but they're all in the NGO world, and so they work through advocacy. There's a new one that comes out of the banking world. There's a thing called the Financial Stability Board, which is a global governing mechanism of central bank governors that sort of sets guidance to keep the world's financial system stable. And they have formed a climate change disclosure task force, spearheaded by Mark Carney, the governor of Bank of England, but all the participating governments, including the US government, nominated people to be members of this task force. It's chaired by Mike Bloomberg. It hasn't had its first meeting yet, and I'm on it. And as I think one of the only Americans, so it's very global. And its objective is to set out guidance, voluntary guidance, to financial institutions, investors, issuers, underwriters, lenders, etc., on what are the expected disclosure around climate risk. And that is spectacular. So in their wisdom, so the Bloomberg folks are managing this, and they're brilliant. At the first meeting, all these groups are presenting. Ceres, CDP, SASB, WBCSD, all those acronyms are all coming to present their kind of worldview on this topic, so that hopefully this thing will sort of take in all of this advice and come out, and it's on a pretty fast time frame. It's a year, and come out with guidance by the end of 2016 around this. So that there is a lot of hope in this world, this little world of transparency, disclosure, and reporting, MRV. There's a lot of hope around this, a lot of expectation around this FSB task force. So we're very excited about it.
That's great. We're moving along through our first hour here, and I want to take the opportunity to turn to the audience for questions. And then what I'd like to do is come back at the end and do a little bit of sum up. But we have a question from the web, from one of our listeners on the web, from Joseph Chepsoy, who asks, can any of the panelists' institutions fund commercially viable community or village-based CO2 reducing business enterprises that also create employment? You were talking a little bit about aggregation, but do you have, Vikram, but maybe, Matt, do you have any thoughts on that?
You want me? I can go first.
Okay.
So can you just repeat that particular phrase, because I think it's important.
Yeah, can any of the panelists' institutions fund commercially viable community or village-based CO2 reducing business enterprises that also create employment?
Right. So I think I can give you actually several examples, and a lot of them are rooted in exactly what he's talking about in terms of CO2 reduction. The carbon markets have sort of lapsed for the time being, and therefore there is hope that the next round will come. But there's a lot of results-based finance that's going on currently using the old sort of the framework that the carbon markets created in terms of the rigor of what those emission reductions looks like. So results-based finance is effectively using that rigor and using that framework to validate the results and then pay for them. And we are definitely working on community-based type projects, whether it is biogas digesters. We just actually signed a deal in Kenya last week to support with $8 to $10 million worth of results-based finance for biodigesters to be put into communities at household level and at the community level. We are working ultimately, essentially for cook stoves. We are working on cook stoves. We are working on energy access, rural electrification, and the bank is, of course, doing a lot in that regard, but it's supported with a lot of the results-based finance as well. So in energy access, and the IFC itself is doing a lot of financing, usually either through domestic financial institutions or through funds, because funding some of these smaller enterprises directly becomes a challenge and expensive. So you probably don't want IFC doing that. But again, finding intermediaries to deliver that. So commercial financing, results-based finance, and of course through the public sector, the bank, a lot of funding is going into financing these commercial community-based projects.
That's helpful.
So it's more than theoretically possible. To say yes to that it has the risk of being a commitment. But the most exciting single transaction I was ever involved in before I worked at JPMorgan Chase was a carbon trade, and this is the tragedy of the downfall of CDM in the carbon markets, because it was a trade between a Wall Street bank and an intermediary that was aggregating investment capital and putting it out into really, really small sort of energy conversion businesses. 40 countries. The greenhouse gas reductions were measured in the kilos, not the tons. Really small. 2 checks from Wall Street to intermediary to village-based business. 2 checks away. That's brilliant. And sadly, we lost that. We lost that in Copenhagen effectively, and that. So that's not there. I haven't seen it, but there's a but, which is working again through intermediaries, and the key there is the aggregator intermediary, which is what you said too, because the big banks that are in London and in Hong Kong and New York, they can't do little things like that, and so intermediaries who are both cultural intermediaries as well as financial intermediaries are essential, and there's work going on right now in ag, sort of climate smart ag, to try to attract private capital there, clean energy, and so there are work streams on all those issues, but we lost a pretty vital instrument. It made it a lot easier.
And that's sort of the bridge we have in terms of, but it's not enough, right? I mean, the 300, we have close to about, if you exclude forestry, we have about $300 million in results-based finance currently, which is nothing. It can only do demonstrators. It can only show sort of the models that could hopefully be replicated back to scale once the markets are back and there is value either domestically, because the INDCs will put it in domestic emission trading markets, or global ones, as to come back to the kind of structures Matt was talking about.
Let's go to the room. We have a question over here. Catherine.
Yeah, hi. Catherine Stratus with the Global Climate Change Office at AID. I had one question about the green bonds and its standards. And do those standards also address climate risk in the sense of looking at climate forecasts and ensuring that, say, the infrastructure that you're building will be more resilient? Do they address that, or just emissions?
Well, you guys address it.
Okay,
but
so
we don't.
We hope to. So the green bond principles don't address the issue of climate risk per se. the
green bond principles, which is the bank's version of a standard. There was deep reluctance on the banks who were developing these to opine as bankers on greenness. What is climate resilience? We're not in that business. So what we did, and there was a debate about this. I mean, the equator principles for project finance do opine on sort of what is green, what is socially responsible. But these folks, largely because it was led by actual traders and bankers, not by the folks in my function. We were sort of in a support role. They referred to the exhaustive versions of these policies in the NDBs, the IFC, the World Bank, European Investment Bank. So it was sort of by reference. So the green bond principles is a process of essentially accountability and transparency, not of performance.
In fact, so the thing there is, so just building on that, at IFC we have something called performance standards, right, for environment, social governance, which sort of underpin the so-called equator principles as well. And so all the projects have to comply with that. To the extent that this is built into that, it is covered, but it's not directly addressed. I mean, I have my ex-colleague and friend Alan Miller in the room here, and while he was at IFC, there was a lot of work started. It got stalled, but it's building up again on developing a climate risk screening especially for certain sectors, primarily in infrastructure. And the issue there is, you have to, and this applies down the value chain at the end of the day, any investment going into infrastructure should be looking at resilience. The normal has shifted. you cannot rely on past historical data anymore. So what is going to be the future in terms of, and we are going to be in the middle of a debate 30 years from now, where we have financed a whole bunch of projects with long-lived, if you will, lives. So should we not be worrying about it? And internally, and this is not to scare people, the parallel we make is this could be big tobacco revisited in 30, 40 years. As financial institutions, do we have a responsibility to be looking at climate risk and looking at how the normals will shift into the future? Because if we are financing it, then could we not be asked 20, 30 years later that if we knew this was a risk, why didn't we try and address it? So we are well underway in a pilot in terms of trying to create the toolkit that will help our investment officers actually, and the decision makers, their bosses, help actually go through sector by sector what the key issues are around risk so that every investment we do is resilient.
I don't think that moment's 30 years away. I think that moment's sooner than that.
But
No,
I
no,
think that's
okay.
the source of your basis points or decreasing the risk commercially.
Yeah.
I think that might be the
And I
source.
think the other thing about resilience is going to be insurability. I think where Matt is right. I mean, I was talking about more the reputation risk and the issue around big tobacco that could be 30 years, but I think the insurability issue for infrastructure is going to hit us much sooner. And I think that's going to underpin a lot of where resilience and the driver for the private sector to invest in it is going to come from.
Let's take another question. We have one back in the back there.
Eric Hyman, USAID Economic Policy Office. Question for Vikram. We had heard in an earlier seminar in this series that the World Bank was considering a policy that would apply a shadow price of carbon of $30 per ton or so in its cost-benefit analyses of new projects. Could you give us an update on whether this has been instituted yet?
Well, I can't defer to Matt on that one. This was directly to me. So yes.
You could.
That is still the stated goal and plan on the bank side of the business. IFC will try and pilot it, and the bank is starting to do it. We are going to the board with an update, and so the internal pricing in terms of the economic analysis is being rolled out, and it's still not sort of, if you will, done across the board, but I couldn't give you a more specific update than that, but I am happy to sort of get back to you on it with some more specifics after the seminar.
There's an interesting question here. Can I answer it?
Yeah.
The question is, how much of a spread do you need to unlock the market? And I'm sorry, but I don't know the answer to that. I threw out 5 basis points. I think that would probably be enough, but I don't know. So that's a great question, and the question includes, is there any research that we've done? We haven't. But that's exactly the right question, and I apologize. I don't have the answer.
Let's take another question. We have another question from the listeners online. This is a question from Sohi Gu, and the question is, how does adaptation finance fit into all of this? So one of the themes that we talked about in our earlier yesterday is that there may be different flavors, different kind of experiences in different sectors, if you will. At USAID, we talk about 3 pillars of funding: clean energy, sustainable landscapes, which encompasses forestry and agriculture, and adaptation and resilience. And so this is a question about adaptation finance. The questioner notes that adaptation finance is even difficult for the developed countries, and many of the instruments or sectors mentioned in this discussion are targeting mitigation. Water, agriculture, waste management, and other sectors need more than public finance. How can we meaningfully scale adaptation finance? Are there specific instruments or programs that will help with these actions, help raise the necessary finance for these activities?
You should answer that.
Okay. All right.
Okay, I'll chip in on your back.
So, and on the one point you should chip in is if you sort of disagree with me on the fact that I think adaptation is very challenging for the private sector to deal with. In an extreme form, it's a public good, right? I mean, if you look at the way the private sector, the discounted cash flow model is not going to lead you to invest in adaptation if the benefits are 10, 15, 20 years out. And unless, of course, there is either appropriate regulation or disclosure to go with it. So this comes back to the whole issue of disclosure of risks and getting information out there that allows the investors to make more informed decisions. And hopefully pricing differentials will start to make a difference in whether your infrastructure is resilient for its lifetime or not. And this goes back to the point I was making earlier. If your infrastructure is not resilient, if your asset is not resilient and it's not insurable, then you're going to have to make an investment. I mean, there are clear places. Sorry, go ahead.
Well, let me ask you about that, because it seems like if you're a private entity and you're making an investment in some asset, you have an incentive to make sure it's fit for purpose and it deals with the conditions that it will face over its lifetime, the lifetime of the asset. And if you're a public entity, if you're a municipality, say, and you're investing in a road or a subdivision or the water infrastructure that supports that, don't you have an incentive also to make sure that it's going to last as long as it's needed?
So on the public sector side, yes, and it's a different approach. On the private sector side, you would think so, right? But at the end of the day, everything is sort of looked at from a lending and financing time frame. So, and there's no financing that goes out for 30, 40 years. So most of that has to be, can it sort of hit earlier? Of course it will. It can and it will. So that's what I was talking about, businesses looking at it from a different perspective. And I think that shift is beginning to happen. Clearly, as Sohi says, there are areas where the private sector can already operate and already invest, keeping adaptation in mind. Whether this is examples of the kind we invested in a company in Turkey, it was a pulp and paper factory in a place where climate studies clearly show that water is going to be an issue. So they're investing in wastewater sort of recycling and management. That's one example. Investment in drought-resistant seeds is another example. Another example is the one that sort of links into the forestry landscape side of the things, is the whole greening the supply chain. Whether it is making sure that your coffee is adapted to coffee rust, for example, which is another project from an advisory perspective we've been doing, and Gabriel can give us chapter and verse on all of that here in terms of what all private sector can do. But when it comes to sort of the non-obvious ones, I think that's where we are going to need a public-private model, especially at the cities level, you said, right? One example people are very fond of giving is what happened down in New York with Battery Park, where the coastal defenses were built up by the public money, but that allowed private funding to flow to do the commercial development around it. So there are ways in which you can address adaptation. It doesn't have to be in terms of making cities resilient and all the infrastructure resilient. It doesn't have to be the same money flowing into the same pocket, but there are partnerships that can be developed around ensuring that adaptation pays.
Okay, let me go to it. We've got some more questions in the room. Why don't we take 3 questions? And so we've got one here. I think we have one back. We have one. Let's start with the gentleman with the microphone. We'll come up
He's
here
got the mic,
take
so.
another question. Yeah.
Thank you. I'm Mike Ashford, independent consultant, and I thank you for the comments on the bond financing for the adaptation. I think that's something that I was hoping to hear more about. This is a comment and then a quick question about municipal financing, project financing, where the public sector does go out 30 years and creates a market for the private sector to come in and build infrastructure. That seems to me the engagement point for adaptation that I'm always hoping to hear more about. Could you, the example of the carbon markets, so that check to check that's gone now, could you add either any 3 of you on the panel add some more examples about where these credit markets are actually translating into moving into projects or programs that lead to energy development or other mitigation or adaptation for that matter? We see things where the World Bank is guaranteeing something and private funds quickly mobilize for perhaps a gas power plant in Africa. We know that that's displacing other more carbon-intensive energy sources, perhaps except for hydro and solar that aren't feasible. But we're not measuring it. But those are, I think, more discussion about where those de-riskings, those guarantees are occurring, would help a lot in these types of venues because it'll enable us to understand what the green bond market potential is with all that undeployed capital, where those actual actual projects or programs occur that are being
More
de-risked.
granularity at some point.
A little bit more, yeah. Thank
I
you.
want to take a few other questions. Let's just rack them up. We had a question right here, and then I see Mark's got a question as well.
Hello, Matt.
If you can keep your question brief.
Yes, it is. The question's for you. So, having worked for 20 years on the opposite side as a buy-side analyst or as investment management, as Gabriel Toomey, and being a banking analyst. Yeah. So my question is, I observed that there are 3 large banks in New York that have about 750,000 employees: Citi, Bank of America, and JPMorgan. Those are the employees globally. How do we, using a two-part strategy internally from the top down, incent that 750,000 individuals to each of themselves sell climate finance product?
Interesting question.
So it's as an HR role. How do you repaper everybody's contract? So if I'm a bank teller, I get a $10 bonus. If you give me a bank hope.
I think we've got that.
You got it? Okay, thank you.
Let's go to the next questioner. Marcy.
Earlier, Matt in particular, you had mentioned that you've got a lot, trillions of dollars in assets too. And you hinted at something that we found when we were just looking at clean energy financing in Liberia, when we did the training on what we call the Climate Energy Lending Toolkit that USAID has produced. We would have the bankers respond, no, we're not lending in energy. Then we said, wait a minute, do any of your projects that you're lending to have energy components? And all of a sudden the hands went up. And they said, yeah, I guess. So we were referring to it as embedded climate change aspects of their investments portfolio. And that, I think, a bit what you were touching on. How do you turn many of the trillions that you're already lending, and those people that you're lending to, realize that within that portfolio you have a lot of embedded climate change risks? And I don't know if that's an area where you're really looking at or not, but you seem to hint towards that, so I thought if you could talk about that some more, that would be really good, because, again, that was a leverage point where I saw a lot of light bulbs go off in our workshop.
Okay, I think I saw 2 other hands. We have one back there. You can just tell us your name and organization.
Yeah, I'm Jette Finsen with Apt Associates. I have a question for Vikram about, the goal also of COP21 was mobilizing finance in the most vulnerable countries, but of course that's also where there's more risk. So what is the bank working on to help de-risk, particularly there, to meet that? Because that seems to be a very important target for meeting the COP21, sort of moving it forward.
Okay. So we had a question essentially on the granularity. How can we create more granularity and on our understanding of the space and the needs for de-risking? Another question on de-risking. A question about 2 questions related to how do we leverage the sort of intrinsic balance sheet and human capital or human resource of the bank, the private banks, to work on climate change. One about bank employees, the other about the embedded climate change aspects of the existing portfolio. So why don't we actually take the 2 bank questions, for the questions I think they're really for Matt first, and then go to the others.
So of those, B of A's in Charlotte, by the way. They're not in New York, but you get the point. Of those 750,000 people, 45% of them do legal and compliance. So but again, the constraint is product. What is a bank teller selling when they're selling climate finance? And so for those who have a product, which is the debt capital markets desks, they're selling it like hell. And we compete against B of A, and there's a league table. And so really, I think the constraint is what's the product you're selling. We've tried on energy efficient mortgages, and they don't work. There's no consumer pull for them. We've tried here in the U.S. We haven't tried globally. And all the other banks who've tried them, UK banks, Dutch banks, they don't sell. People don't buy houses because they're energy efficient. You can't make the economics change enough to make it a meaningful purchase driver, and it creates transaction costs that are difficult. So we haven't found the consumer finance product that would be climate friendly. So we have some of these industrial ones, and we do sell those pretty hard. On embedded climate risk, absolutely. This carbon asset risk is something that we've been going to school on deeply for the last 2 years, partly because project you were involved in.
There's an issue with your mic. So.
Pardon?
There's an issue with your lapel mic. So
there's an issue. I should be louder.
Now you don't have to. That's for the webinar.
So bank stakeholders would like banks to disclose the financed emissions from their business. And so we had a whole project that Gabrielle was part of around financed emissions. And when you get into that discussion, you realize that the bank has no risk on financed emissions. But what they may have a risk on is the embedded carbon, a potential liability on paper that they own. So we call that carbon asset risk, not financed emissions. And so we've gone seriously to school on that, and it's something we watch very carefully. When we're lending, we do, as a matter of risk management, and back to that adaptation question earlier, you know, if it's a dam, is the river going to dry up? If it's a factory on a coast, is there going to be a hurricane that's going to blow it away? That is absolutely part of the risk management model that we're doing. And this is where this FSB task force, I think, is going to be helpful, because the analytics around what you described, these things that are embedded, so all the banks, the U.S. banks, oddly the Europeans haven't done this. The U.S. banks, except for us, have big numbers that they put out. We will invest $100 billion in the next 10 years into climate finance. We just thought it was a little squishy. We actually ran our own numbers, and our number would be 150. And we actually did 30 in the last 2 years. You know what we don't count? All the green finance that a utility would do. We don't count that. We count pure play in there. And on the converse side, you don't count necessarily the embedded liability there. So we need to start looking at what's on our books through this lens. If it becomes a meaningful risk issue, right? So that you now have risk in there, and you therefore you have opportunity in there. That's where we're headed.
Because the point in Liberian banks was for this SME,
You don't need this?
60% of their cash flow was going out. Sorry, for the Liberian banks, what they began to realize is 60% of their loaners, cash flow was going out to pay for diesel or for electricity. It was so high.
Yeah.
And they never realized that that was the major reason that could make them have loss of repayment, basically, too.
Well, we're further down the chain than that. We're not missing 60% of our cash flow, but it's still an issue that we don't feel comfortable we have a full handle on.
I want to come back. We had a couple of questions that related to de-risking and granularity, but we're getting to the end of our. We have about 8 minutes left, so I want to come back to some summary kinds of questions as well for each of you, and that is, first, what are your top institutional priorities for mobilizing climate finance investments in mitigation and adaptation? And then secondly, what would you have on your wish list, if you will, for the next 2 to 3 years? What would you like to see happen the next 2 to 3 years to help us implement the Paris Agreement and drive towards emission reductions and the associated transformation that's necessary to keep us below 2 degrees of warming? So if you could give us your thoughts on that. Vikram, let me start with you, if I may. If you could, maybe for 2 to 3 minutes, and then if you have thoughts on the granularity questions as well as you're speaking, that would be great.
So let me just briefly address the granularity question, just to give a sense.
I had the same question, by the way.
Okay, I mean,
can you give us examples?
We can give you examples of things we've done and things we haven't done. On the small scale, I mean, and I don't know the huge details about it, and we can get some together about it, but there's a company called B-Box in Tanzania that recently issued a note for $25 million. And so it's a small number. They actually mobilized investors to, I think they were aggregating off-grid energy access investments, right? Or rather, installations. So that's on the extreme end. Will it become a bond? One day. Like I said, everything is going to grow up to be one. In terms of But bonds are not easy to issue. They are a very standardized product. They're easy to sell, but getting them there, it's going to be challenging, and that I think
I don't
is
know
the
why anyone
partnership.
teased you for that. I think it's a cool notion.
Yeah, it's a cool notion. Okay, good. Another example, let me give you. We in Jordan, and this is an IFC example, we helped simplify. We worked with the country to help simplify the sort of regulations around it. We arranged for long-term offtake, and then we provided some sort of risk management, credit enhancement around it as a pool, and we approached it, and I think it's called the Seven Sisters or something, and then it turned out to be the largest solar deal in MENA because we actually addressed it as a issue upstream as opposed to looking at each individual transaction and having to sort of customize it. So de-risking can work at the project level, but I think de-risking upstream in terms of getting the regulation in place and in terms of getting all of that is key. So I think just sort of segueing that, the vulnerability question is not my expertise, but maybe offline I can give you an answer on that. I haven't forgotten that. But in terms of what is sort of, and let me sort of look, what is our sort of wish list? I think just segueing from where we are, if you're going to ultimately help countries do what they need to do and try and unlock either domestic or hopefully one day the international sort of capital flows, you're going to have to reduce the cost of sort of doing these large, whether it's public-private partnership-based infrastructure projects, and you're going to have to provide some level of certainty, right? And you're going to have to address this whole issue around political risk, the policy risk. Okay, technology, I think, is starting to address itself, but there's technology and operational risk is sort of the private sector's ability. The capacity to absorb this money and to deploy it and to leverage it is sort of the capital markets issue. But the government also has a role on political and policy risk, right? So how are we going to help provide that kind of certainty? This goes back to the example I was giving, where the bank's trying to establish the strategic investment funds to help countries create some sort of a financial pathway to getting this done and have skin in the game. I mean, the broader issues of addressing local currency risks and de-risking all that is going to continue to be a challenge for financial markets. But there is a role that governments can potentially play in that. We have to build capacity of local financial institutions and the domestic capital markets for all the reasons we've already discussed, because at the end of the day, they are going to be key in terms of helping all this money sort of either come in, or a lot of countries are already pretty liquid. But how do you get the reform done and how that? And I think finally align regulation with green investment. And this goes back to disclosure, this goes to financial regulation, it goes to regulators working with the ministries of finance and the planning and development ministries, so that if they all align around what the INDCs want to do and the implicit long-term business plans these INDCs represent, right? So you're going to have to unlock this along with sort of the ecosystem around it in terms of de-risking. And that's going to get private flow. I mean, it sounds grandiose, but I think those are sort of the building blocks. Because even at IFC, when we sit, you can do one-off projects, but you're not going to reach the impact you need to.
That's a good summary. Matt, in 2 to 3 minutes, your wish list and...
So we talked about the green bond wish list, that the green bond market creates a spread over regular bonds. There was a recent regulatory change in the asset management business that said investing for social responsibility, ESG, environment, social governance, is consistent with fiduciary responsibility, which gives permission, in fact, even an obligation for a hired asset manager to consider ESG issues when they're investing capital. Prior to that change, that was a huge barrier to most asset managers to even think about this. So with that regulatory change, my wish list is that our asset management business will have full-on ESG integration across the entire platform and dedicated products and so on and so on and so on. To that point, on Monday of this week, we announced a one-stop shop for sustainable investing called Ethos. And what I love about this is a group of traders in London who thought this up. They did a trade where they took a World Bank green bond. We announced it with the World Bank. A World Bank green bond and then an equity index. They combined it together. That's called structured products. and they placed it with a European institutional investor. So we did a trade to save the world, right? But it was just a trade. These are folks, and they love it. They love this trade. So they built a business out of it. And gosh, I hope that business explodes. And I hope these guys make a ton of money. So that's kind of, we have this cool partnership with a nature conservancy called NatureVest, which is trying to bring commercial capital into conservation. I wish that group unlocks billions of dollars in conservation dollars. And then finally, on the implementing Paris, I have huge hopes for this disclosure task force. It's tectonic in its nature. It's sort of in the category of boring but important, and that we're going to create permission and an implicit requirement for much greater disclosure, so that we can do the kind of analyses, Marcy, that you were talking about.
Great, thank you, Matt. So our 90 minutes has gone quickly. This is a very brief summary of, even just like an opening exploration, really, of this space, which is very vibrant and dynamic. Really appreciate all of you being with us. And just to sum up, it sounds like the wish list includes reducing risk, building capacity of local financial institutions, aligning regulation with green investment, full-on ESG integration across asset management businesses, and more work on disclosure. So thanks to all of you. I don't know, Marcy, do you have any closing words?
No. Thank you very much for coming to the people on the webinar, for the people here today, and thanks to Crown Agents, as always, as a prime contractor on CEADIR, for hosting this too. So more to come. We'll be having a new seminar next 2 weeks on the 18th of February on financing climate services. And that's also interesting because basically it's saying what are the socioeconomic benefits of climate services, which is people often think of those as the meteorological services, and indeed how do you get strong systems in place for not only measurement and also getting the information out with regard to what are going to be the impacts, that climate change impacts on investments, on protecting the environments too. So it'll be very interesting. Thank you.